Nick, very good to see you as always. Today, we're going to walk through 4 tips for investing during a recession. Recent market volatility, inflation, and interest rate hikes. So, we wanted to walk through all those headlines and a few tips for investing during market downturns. The first one is kind of a question, though. Is cash really king? Are you recommending that people invest more of their portfolio in cash right now?
Well, yeah, I do. And especially because, it's always important to have a cash stash. And I always say at least 6 months worth of expenses, because what happens is a lot of people, when the stock market goes up, they think, oh, I don't need to have cash because the market's going up and that money's not earning anything. So then they take money out of cash, they stick it in the stock market, then the stock market goes down. And in order to pay for that air conditioning unit that went out, they got to sell stock at losses to be able to come up with the money to be able to pay for it. So that's why I always say I get it. Cash is not sexy, but that's not the importance of it. The importance of it is to have something you can go to pay for those things whenever there is market volatility. But here's what's not a cash stash. Not a cash stash is saying, oh, I have mutual funds that are my emergency funds.
Right.
That's not right. And I see there's a lot of people that actually do that. So those are a couple things, but what you don't want to do is just say, I'm not going to have any cash because cash is not cool. I always say at least 6 months worth of your expenses built up in cash for those rainy days.
Right. Okay. Now, how about defensive stocks? I hear about them being kind of
Right.
recession proof. Walk us through that, please.
Well, those can be good options too. So long as the stock market doesn't crash, because like we talk about, a rising tide lifts all ships, but so does a tide that goes out. It's going to affect different things. So defensive stocks or even dividend paying stocks, they tend to weather the storm a little bit better, but it doesn't make them immune from ups and downs of the market. So, defensive stocks definitely, we're healthcare, consumer staples, utilities. I mean, we think about some of these things. People need healthcare during a recession. People need toilet paper during a recession. So those companies will tend to weather the storm better, but it doesn't make them immune from ups and downs either.
Okay. So, Nick, next question then is about dividend stocks
Right.
and fixed income investments like bonds.
So defensive stocks, like you just mentioned, and then dividend stocks, they tend to weather the storm better because the idea is that even in a recession or a downturn or a market correction or a market crash, dividend stocks should still pay the dividend. So while the market's going down, you're still collecting the dividend all along the way. And that's the whole idea behind it. And it's why if we look at 2022, even though the market was down, dividend stocks tend to outperform during that point in time. But as far as fixed income, usually when we talk about fixed income, people are talking about bonds. And I don't really like bonds because of the interest rate risk. Just last week, the Fed increased the interest rates again. And so what does that do to bond prices? It can cause bond prices to go down in value. So instead, I like bond alternatives. One example of a bond alternative would be something like structured notes. Structured notes can offer strong interest rates. They're typically shorter term, maybe about 1 year. The risk to your principal is maybe if the stock market goes down over 30%, then you get hurt. So that's a pretty big buffer to the downside. But all along the way, the nice thing about it is you can get a good interest rate all along the way. And sometimes those interest rates are better than bonds. And, whereas bonds, if the Fed hikes up interest rates, you're feeling that immediately. With some structured notes, having that 30% buffer to the downside is nice because now you don't really get hurt until that big of a drop. And that's a pretty big drop.
Right. That interest rate risk is what essentially
Big
led to the banking crisis as well. So that is a very cautionary tale. Good point. Next, even during downturns, or especially during downturns, keep investing. That is known as dollar cost averaging.
So if you're in savings mode, what I say is don't stop. This is when wealth is created. When you invest when prices are down, and that's, as the saying goes, you buy low and you sell high. And so that's the idea. Usually, but what we find is during a market downturn like we've seen, people will say, well, the market's going down, so I'm going to stop investing. And that's kind of the worst thing that you can do because of dollar cost averaging, like you said. Of course, that works when you're saving. So when you're saving and you're in maybe your 401k or your 403b and you're buying because you're saving, you're buying stock at high prices and low prices. That's dollar cost averaging. The reverse occurs when you retire, because when you retire, you're not saving anymore. What you're doing at that point in time is you're spending. And so we call this reverse dollar cost averaging. When the stock market goes down, but you got to pay the bills because you no longer work. So you're having to cash out of things that you've invested in at losses to be able to pay the bills. And so the bad thing about that is, almost imagine that like a pocket. When you're in retirement, you're tearing open a little piece of your pocket and things are starting to fall out a little bit because you're spending. But if all of a sudden the stock market is going down simultaneously, what ends up happening is it's like taking that little slow bleed out of that pocket and tearing it wide open. And now all of a sudden, it's not just you that's losing money because you're taking money out, but now the stock market's losing money. And this is what can cause people to really run out of money during retirement, is because of reverse dollar cost averaging. So something very important to protect against and plan for.
I like that analogy, though. That really does help it make sense. So last, I think, we come back to what we always say, which is it's so important not to react emotionally and stick to your plan. Here's a few tips. Keep calm. Don't try to time the market. Avoid panic selling and stay the course.
Yeah, it's not timing the market, it's time in the market. And these 4 tips are very cool. Just because I think what happens is we see the market go down. We hear about interest rates going up. We hear about hyperinflation or whatever. And when we turn on the news and we get emotional.
Yeah.
And what I always tell people is it's math versus your emotions. Use math versus your emotions. Build a plan that you can live with, a plan that's been stress tested, so that you can say, hey, you know what? I have something that's been mathematically tested so that I'm going to be okay in both good or sour markets. A lot of times a person's plan, for most Americans, their plan only works if the stock market is favorable. And so what you always want to do is make sure that your plan can withstand, market downturns and market crashes. We had a live event last night, and one of the things that I talked about with, to the room, was that what we end up seeing is that, somebody retires at 65, now they're living to 95. So that's like 30 years of unemployment. And the stock market, we follow something called the rule of 5. What that means is every 5 years, we typically have a market crash of over 20%. So if a stock market crash happens every 5 years and you live 30 years in retirement, that means you're going to, in essence, be having to live through 6 market crashes.
Right.
And so you better have a plan that can withstand both good and sour markets, because they happen all the time.
Right. And I know that's something that you specialize in, stress testing those portfolios. So Nick, if somebody has questions about investing right now, or if they're properly allocated, what's the best way to reach you?
Best number is just to give us a call here at the office at 844 Group 10. There's also a great plethora of information on our YouTube channel, youtube.com/Group 10 Financial. And, and you can go to our website, group10financial.com, and you can schedule visits right there. Because ultimately what a stress test is where you take your financial shopping cart, kind of like going to Publix. You go to Publix, you put things in your shopping cart, and then they scan it, and then they tell you how much you owe. In essence, what a stress test is where we take your financial investments in your financial shopping cart, scan them, and we can be able to tell if your money is too risky for the return you're getting, or if you're right on track. And what we find is about 80% of Americans have a mismatch. They have a lot more risk than what they thought they had, and that's got to get fixed.
And then it comes down to peace of mind. I love it. Nick, well said. Thank you so much for your time today.
Aaron, great being with you.